Okay, we'll finish the rest of the chapter 12 questions. The first one here is problem 12-1A, and it reads, this Pekin Theater owns and operates movie theaters throughout Florida and Georgia. They declared the following dividends: 80, 90, 150, 150, 160, and 180. During the entire period ended December 31st, the outstanding stock of the company was comprised of 250,000 shares, cumulative, preferred, 2%, $20 par. All right, and before we move on, let's take our calculators out and let's calculate what it should be that they are due. So it's 250,000 shares times $20 par times 0.02. That would require 100 grand every year for preferred. And it says they also had 500,000 shares of common at 15 bucks. It says here determine the dividends. So this is exactly like what we did in a previous problem. So we just record here what the dividends were each year. They got 80, so common got none. Remember, we need to give them 100, so we're short 20. Let's just keep track of that, short 20. Here they have 90, of course, they're going to get it all, so now we're short 10. So we have a deficit of 30. Now we have $150,000 available, so they're going to get all 100 that they're due, plus the 30 that we were short, so all 130. The balance of 20 goes to common. And as you notice here, all of these are well over 100, so they're going to get their 100, and the excess goes to common. Okay? I can let you read numbers 2 and 3 as those are very straightforward. Problem 2A. It says here, on December 1st, the following accounts and balances appear in the ledger. So they got preferred, paid in capital for preferred, common, paid in capital for common, and then retained earnings. At the annual stockholders meeting on March 31st, the board of directors presented a plan for modernizing and expanding plant operations at a cost of $11 million. The plan provided, 1, that a building valued at $3.375 and land valued at $1.5 be acquired in accordance with negotiations by the issuance of 125,000 shares of common. B, 40,000 shares of unissued preferred stock be issued through an underwriter. And C, the corporation borrowed $4 million. The plan was approved. May 11, 125,000 shares of common in exchange for land and building according to the plan. So the building was valued at $3.375. The land was valued at $1.5. They did 125,000 shares, and the par, if you look above, the par is 35 bucks. So if you look at the problem, it gives you that number. So there is our common stock credited. This, if you will, is kind of like the plug. We got to make it balance. On the 20th, they issued 40,000 shares of preferred, 52 bucks cash. So 40,000, you look in the problem, the par was 50. They sold it for 52, so there's a $2 difference, times 40 is 80,000, cash is 2.8 million. And then that last one is they basically took that as a note, so debit to cash, credit to notes payable. And then the last one for chapter 12 is problem 3A. And it says here the following selected accounts, again, so we've got what's in our stockholders' equity section. During the year, the corporation completed a number of transactions affecting stockholders' equity. So let's just walk through here. Letter A, issued 200,000 shares at 12 bucks, 200,000 shares at par, $7 goes to paid in capital in excess of par. Letter B, issued 8,000 shares at $115. 8,000 shares, par is 100. They sold them for $115, paid in capital, and all goes to cash. Letter C, purchased common at $10. That's what we put it in at, $10. Letter D, sold some of these shares at 14. We remove it at what we brought it in at, 10. There's a $4 difference. That's going to go to paid in capital for treasury stock. All goes to cash. Letter E, sold 30,000 shares of treasury at 8. Now it's less than. So we take it out at 10. We had a difference of $2, so the 2 times 30 is our debit to paid in capital, and of course all goes to cash. Letter F, declared a dividend of $1.25 per share on preferred and 8 cents on common. So first of all, we're declaring it, and the declaring it just means we recorded the liability. Letter G, we actually are paying it. But the big deal here is how many shares do we pay that on? And that's what this part of the problem details. So preferred, if you look in the reading in that stockholders' equity section, there was 80,000 shares out there, which is taken to 8 million divided by the 100,000 shares. In transaction letter B, we issued 8,000 more shares. So our total shares for preferred was 88 times $1.25. Common, again, you look at that stockholders' equity section, the detail there that there was 4 million shares issued. Transaction A, we sold 200. Transaction C, we purchased 175. We brought them back into treasury. Sold another 110. Sold another 30. So we're left with a net of 4.165 million at 8 cents a share, 333,200. The sum of those two is our 443,200. F is first is recording the liability. Letter G, we actually pay it. That concludes our work for Chapter 12.